You've heard the statistic. 90% of traders fail. But have you ever wondered why? It's not because they lack a winning strategy. It's not because they can't pick the right stocks. It's because they don't understand the single most important rule of the market, the one principle that separates the consistently profitable from the perpetually broke. It's not about how much you can make. It's about how much you can't afford to lose. By the end of this video, you will learn the mathematical trap that ensnares most traders and discover the professional mindset that transforms trading from a gamble into a business. Let's talk about the brutal math of losing. Imagine you start with a $20,000 account. You take a few bad hits and lose 25%. The biggest mistake amateur traders make is focusing on their win rate. They boast about winning 7 or 8 out of every 10 trades, but that's a vanity metric. You can have an 80% win rate and still lose money if you're 2 losing trades. Wipe out the profits from your 8 winners. Conversely, a trader can be profitable with a 40% win rate if their winning trades are significantly larger than their losing ones. The secret isn't winning more often. It's losing less when you're wrong. The market will always present opportunities, but you can only seize them if you have the capital to play. Your success is not defined by your best trade, but by how well you handle your worst ones. So, how do the pros protect their capital? It starts with a non-negotiable rule. Never risk more than 1 to 2% of your account on a single trade. If you have a $20,000 account, your maximum risk per trade is $200 to $400. This isn't a guideline, it's a law. By risking only 1%, you could endure 100 consecutive losses before blowing up your account. Risking 10% per trade gives you only 10 chances. One bad week could end your career. This strict risk management does something magical. It removes emotion. When you know that no single trade can significantly harm you, you stop making panic decisions. You can stick to your strategy with confidence, knowing you have enough ammunition to survive the inevitable losing streaks and stay in the game long enough for the winning ones to appear. But the 1% rule is incomplete without its other half. Correct position sizing. This is the crucial step most beginners miss. Risking 1% doesn't mean you just buy a small number of shares. It means you calculate the exact number of shares to buy, so that if your stop loss is hit, you lose exactly 1% of your capital, no more. The formula is simple. Position size equals total account, capital X risk percentage, / entry price stop loss price. For example, with a $20,000 account and a 1% risk, your dollar risk is $200. If you want to buy a stock at $50 with a stop loss at $48, the distance to your stop is $2. Your position size would be $200 divided by $2, which equals 100 shares. By using this formula for every single trade, you make your risk a constant. It doesn't matter if a stock is volatile or stable, your dollar loss will always be controlled. This is how you standardize risk and truly professionalize your trading. Let's reframe how you view your trading account. It's not just money, it's your inventory. A baker wouldn't throw away his flour. A carpenter wouldn't break his hammer. So why would a trader carelessly waste their capital? Every dollar you lose is a tool you can no longer use to build wealth. This is why you must define your exit before you even enter a trade. Amateurs focused on the entry point, dreaming of profits. Professionals focus on the stop loss, planning for a potential loss. They know precisely where they will cut a trade if it goes against them. This isn't pessimism. It's strategic defense. By predefining your risk, you prevent a small, manageable loss from turning into a catastrophic one. The path to long-term profitability is paved with boring, consistent, and disciplined trades. It's about the power of compounding, not gambling. A trader who makes a steady 5% a month will vastly outperform the one who makes 50% one month and loses 40% the next. The flashy traders on social media showing off huge wins are not showing you the blown-up accounts and devastating losses that came with their high-risk approach. The real winners are the ones who are still trading 5, 10, and 20 years later. They're not the flashiest. They are the most resilient. They built their wealth not by getting rich quick, but by refusing to go broke. Here is your action plan, starting today. 1. Calculate 1% of your trading account. This is your maximum risk on any single trade. 2. Before you enter any trade, determine the exact price point where your analysis is proven wrong. That is your stop loss. 3. Use the position sizing formula to calculate the exact number of shares to buy. If you can't get a small enough position, you skip the trade. 4. Honor your stop loss. When the price hits your exit point, you close the trade immediately. No hoping, no hesitating. 5. Keep a detailed trading journal. Analyze your losses to find patterns and eliminate repetitive mistakes. This framework isn't about limiting your potential. It's about ensuring you have a future in the market. By protecting your capital, you give yourself the most valuable asset a trader can have. Time. Time to learn. Time to adopt. And time to let your edge play out. That is the real secret to winning. Let's dive deeper into the psychology of capital protection. Why is it so hard for traders to follow these simple rules? It boils down to a few cognitive biases that are hardwired into our brains. First, there's the get-rich-quick fantasy, fueled by social media and stories of overnight millionaires. This creates an unrealistic expectation of returns and encourages reckless behavior. We want to believe that we can be the exception to the rule, the one who turns $1,000 into $100,000 in a month. But the market is a brutal teacher, and it doesn't care about our fantasies. Second, there's loss aversion. Psychologically, the pain of losing is twice as powerful as the pleasure of winning. This is why traders hold on to losing positions, hoping they will turn around. They can't accept the small loss, so they let it grow into a devastating one. Acknowledging a loss feels like admitting a mistake, and our ego fights against that. But in trading, admitting you're wrong quickly is a sign of strength, not weakness. A stop loss is not a sign of failure. It's a tool for survival. Third, we suffer from recency bias. If we've had a string of winning trades, we become overconfident. We start to believe we can't lose, so we increase our position size and take on more risk. We forget that the market's conditions can change in an instant. This overconfidence is often the prelude to a major drawdown. Conversely, after a series of losses, we become fearful and hesitant. We might miss out on good opportunities because we're afraid of taking another loss. The key is to remain objective and treat every trade as an independent event with its own risk parameters, regardless of past results. Now, let's talk about the practical application of risk management beyond just the 1% rule. Another crucial concept is the risk-to-reward ratio. Before entering a trade, you should not only know how much you're willing to lose, but also have a realistic target for how much you expect to gain. A common rule of thumb is to only take trades that offer a potential reward of at least twice the risk. For example, if you're risking $200 on a trade, your target profit should be at least $400. This is a 1-to-2 risk-to-reward ratio. Why is this so important? Because it means you don't have to be right all the time to be profitable. If you maintain a 1-to-2 risk-to-reward ratio, you only need to win 1 out of every 3 trades to break even. If you can win 40% of your trades, you're solidly profitable. If you can win 50%, you're doing exceptionally well. This mathematical edge is what allows professional traders to thrive. Even when they are wrong a significant amount of the time, they focus on the quality of their setups, not the quantity of their wins. Let's put it all together in a hypothetical scenario. Imagine a trader named Alex. Alex follows a strict risk management plan. He risks 1% of his $50,000 account on every trade, which is $500. He only takes trades with at least a 1-to-2 risk-to-reward ratio. Over the course of a month, Alex makes 20 trades. He wins 8 of them and loses 12. His win rate is only 40%. On his 12 losing trades, he loses $500 each. This is the mindset shift that you need to embrace. Stop chasing perfection and start embracing probability. Stop trying to predict the future and start managing your risk. Your goal is not to win every trade. Your goal is to have a trading plan that is profitable over a large number of trades. And the only way to survive long enough to execute that plan is to protect your capital at all costs. Every day you end with your capital intact is a victory. It means you get to come back and trade tomorrow. And in the world of trading, longevity is the ultimate prize.